Have you ever wondered why some people always seem to make money in the market, while others just keep losing? The answer is way simpler than you might think. The market has a natural way of transferring money from the impatient to the patient. And this isn't just some motivational quote you see online. It's pure math, and it's happening every single day. But first, let's bust a huge myth. A lot of people believe that making money in finance is all about predicting the next big move. You know, buying low, selling high, timing the market perfectly. If that's what you're trying to do, I'm sorry to tell you, but you're probably on the fast track to losing money. When I first started investing, I made this exact mistake. Every little swing in the market made me anxious. Every dip felt like a personal failure, and every rise felt like a missed opportunity I should have jumped on. The result, I lost way more than I gained. I eventually realized that my problem wasn't my strategy, it was my impatience and my emotional reactions to everything that happened. So, how do the patient actually make money while the impatient are losing it? It all comes down to three things: time, discipline, and a solid strategy. Patient investors don't try to predict the market's next move. They understand that time is the single greatest ally of their capital. They focus on buying quality assets, they invest consistently over a long period, and they let the incredible power of compound interest and historical market growth do all the heavy lifting for them. Meanwhile, the impatient are constantly jumping in and out. They're trying to guess the next move based on a news headline or a gut feeling. They rack up fees, they pay extra taxes, and in doing so, they are effectively transferring their hard-earned money directly to the patient investors. It's a cycle that repeats itself over and over. Let's put some real numbers to this to make it crystal clear. Imagine two investors. Let's call them Impatient Ian and Patient Penny. They both buy shares of the exact same promising company, but at the first sign of a market dip, Ian panics and sells his shares out of fear, probably taking a small loss. Penny, on the other hand, holds on to her shares. She might even buy more when the price is low. She reinvests her dividends and simply holds on for years. Over a decade or two, the difference in their outcomes is astronomical. Ian's money, the money he lost by selling in a panic, essentially fed the growth of Penny's portfolio, and he probably never even realized it. And this principle doesn't just apply to stocks. It's the same for real estate, for REITs, for ETFs, for bonds, pretty much any investment that relies on long-term growth and compounding. The real secret isn't to time the market. The secret is to not react emotionally to the inevitable ups and downs. The secret is to focus on the fundamentals of what you're buying, to think in terms of years and decades, not days and weeks, and to resist making those impulsive, knee-jerk decisions. Now, you might be thinking, okay, that sounds good, but what if the market crashes and stays down for years? That's a valid concern. But the patient investor knows that downturns are a normal and expected part of the process. In fact, they see these moments as buying opportunities. While the impatient are panic selling, the patient are quietly accumulating great assets at a discount. Market history proves this time and time again. Those who stay invested and keep buying during downturns accumulate massive wealth. Those who flee in fear lock in their losses. Here's another powerful example. Imagine an investor who started buying solid, blue-chip companies back in 2008, right in the middle of the global financial crisis, while almost everyone else was selling everything in a total panic. This investor kept putting money in consistently, month after month. Today, their portfolio wouldn't just have recovered, it would have grown exponentially. That is the incredible power of patience, capturing the enormous gains that the impatient lost because they gave in to fear. And let's be clear, patience doesn't mean doing nothing. It means taking planned, disciplined, and consistent action. It means creating a clear investment strategy and sticking to it. It means setting long-term goals, automating your contributions so you don't even have to think about it, and tracking your performance without getting swayed by every dramatic headline or market rumor. Here's a powerful analogy to help you visualize this. Think of the market as a wide, flowing river. Money is the water, constantly moving. The impatient investor tries to jump from one slippery rock to the next, trying to cross faster, but they risk falling in at any moment. The patient investor, however, takes the time to build a solid, sturdy bridge. They cross safely and calmly, letting the river's current do part of the work for them. So, if you want to start benefiting from this natural transfer of wealth instead of contributing to it, you can start today. First, define your investment horizon. Are you investing for 10, 20, or even 30 years? The longer, the better. Second, choose quality, diversified assets. Don't put all your eggs in one basket. Third, automate your contributions and make sure you're reinvesting any dividends you receive. And finally, you have to train your patience. This is the hardest part. You have to actively practice avoiding emotional decisions and resisting the urge to sell when things look scary. And remember, time is your greatest ally. The earlier you start investing and building your asset base, the less effort it will take later on to maintain and grow your wealth. The magic of compounding works best over long stretches of time. Here's a point that very few people talk about. Patience also means learning from your mistakes without panicking. Every market drop is a lesson. Every swing is an opportunity to analyze what happened, adjust your strategy if needed, and become a smarter investor. While the impatient react emotionally and repeat the same mistakes, the patient learn from the experience and become stronger and more resilient. In the end, the market doesn't reward haste or anxiety. It rewards discipline, consistency, and above all, patience. If you can learn to wait and act strategically, you'll start to see that while the impatient are losing their battles, money is quietly and steadily working in your favor. And that, right there, is the fundamental difference between building real, lasting wealth and just watching your money slip away over time. So, I want you to ask yourself a serious question. Are you going to keep reacting to every market drop and every rally, constantly feeling stressed and anxious? Or are you going to learn how to let time and a solid strategy work for you? The truth is beautifully simple. The patient don't need to get every single market move right. They just need to be present, consistent, and disciplined over the long haul. And that is exactly how money systematically moves from the impatient to the patient. Thanks so much for watching. If you found this helpful, make sure to hit that subscribe button for more content just like this. See you in the next video.